Good afternoon, everyone, and heartily welcome to all our crypto friends. I am Prajakta Murthy, your webinar host, and I'd like to extend a warm greetings to all of you. Additionally, I have today with me Mr. Mohammad Arham, a crypto trader by profession. Today's topic will be crypto futures and option market analysis. You might have noticed that you are in mute upon joining. Please post any questions you may have in a chat box during the webinar. The webinar will be concluded with Q&A session where all the participants' questions will be addressed by the presenter. From the great creator of Odin, MCX, IX, here is the yet another credible and exchange-neutral platform a user can rely on while walking towards the path of crypto and blockchain understanding. Starting from education to knowledge to latest news, all covered under one super app, Trioverse. CryptoWire has now rebranded as Trioverse. From novice to a professional trader, every market participant can have a slice of information readily available on the touch of the finger. Let me first walk you through the Trio service, Trio University, and Trio TV. We are all aware that cryptocurrency and blockchain ecosystem is expanding rapidly, making it tough to keep up with all the events, pricing, and news. However, what if we had a campaign app like a Birdie that walked beside us, think like us, and responds to our expectations? You heard that right. Three is our very own worldwide crypto super app. Let me now take you through the app briefly. Here is the global super app. Let's start with the home page of the app, which covers three pillars: Trio Wire, Trio TV, and Trio University. Under Trio Wire service, we have rolled out India's first global crypto index, IC15. It tracks the performance of top 15 cryptocurrencies globally based on market capitalization. Crypto enthusiasts and crypto traders takes the informed decision based on IC15. Wire Watch. In this session, we can monitor the best exchange to buy and the best exchange to sell a particular cryptocurrency. In the center of the screen, we can also monitor the arbitrage opportunity between two exchanges for the same cryptocurrency. There are more than 350 plus cryptocurrency on a platform with 70 plus crypto exchange worldwide. Trio TV is exclusive 24/7 IPTV covering everything on the crypto and blockchain ecosystem. It's currently available in 4 languages: English, Marathi, Hindi, and Gujarati. And Trio University is the first digital university to offer on courses on blockchain. You can find the best courses offered by MIT Harvard on a single click of the app. I'm happy to have our guest speaker, Mr. Mohammad Arham. Mohammad Arham is an internet marketer who owns a market agency called Grown Big Media and work with a Max Media INC in Canada. He has spent over 2 millions on paid ads and has experience working with various crypto projects. He is also known as the Monkey Kong in trading communities. Recently, he has started sharing his trade views with a small community of 500 crypto traders on Telegram and has 6,000 followers on Binance. Join me in welcoming Mr. Mohammad Arham for today's webinar. Hello, Arham. You can please take over the session.
Thank you so much, Prajakta. First of all, I'd like to thank the organizers for the meeting. And good morning, everybody. Good afternoon, everybody. I am honored to have this opportunity to address such a distinguished audience. So, I'd quickly jump into the presentation. Let's start sharing the screen.
Yes.
So, crypto futures, the rise of digital derivatives. The key takeaways in this presentations are a derivative is a tradable financial instrument that derives its values from an underlying asset such as a cryptocurrency. It allows traders to get exposure to the price movement of an asset without actually owning it. The two main types of crypto derivatives are futures and options. Perpetual futures are a special type of future contracts unique to crypto markets. And crypto derivatives are mainly used for hedging and speculating. They are complex and best suited for advanced traders. So what are futures? Futures are a type of derivative contract agreement between a buyer and a seller to buy or sell a specific underlying asset, such as a cryptocurrency, at a set future date or for a set price. When the contract expires, that is on the set future date, the buyer is obligated to purchase and receive the asset, and the seller is obligated to sell and deliver the asset. In today's modern financial and crypto markets, where futures can be used to gain exposure to price movements of an underlying asset, actual physical delivery of the asset does not have to occur. Instead, the profit or loss resulting from the trade would be posted to the trader's account. This is sometimes referred to as cash settlement. Long versus short. Buying futures is referred to as entering a long position, while selling futures is referred to as entering a short position. So long positions profit when the market price of the asset is higher than the set price at the expiry date. They take a loss when the market price is below the set price. On the other hand, short positions profit when at the expiry date the market price is lower than the set price, and take a loss when the market price is higher than the set price. So, for example, let's assume trader A, he goes long uh, crypto futures contract with ETH as the underlying asset with a price of $1,300. On the other side of the trade is trader B, who is short the contract. For the sake of simplicity, we ignore the effect of marginal effects. So you can see if somebody who had long at $1,300, and if Ethereum reached $2,000, he would have gained $700. And trader B, if he would have shorted, he would have lost $700. So the margin modes, there are like different type of margin modes. Margin crypto futures are traded on margin, which means traders do not have to pay for the full amount of the trade themselves. Instead, a portion of the funds is borrowed from the exchange or trading platform. This allows for leverage, which could amplify gains, although losses could be amplified. The trader might also potentially face margin calls and forced liquidation. So there are two typical ways to use margin: cross margin and isolated margin. Cross margin allows the trader to share the margin balances across different positions. So excess margin, that is equity in excess of margin requirement from one position, can be used to cover margin deficiency from another position. This could potentially be used to help prevent margin calls or force liquidation of a losing position. Smart cross margin. It allows margin requirement offsets for positions in opposite directions. Example, long versus short, and across different products types, example, spot margin and futures. Then comes isolated margins. This is the margin assigned to a single position and cannot be shared across different positions. Typically, traders might use this when they don't want margin calls from a single position affecting other holdings in their portfolio. Perpetual futures. These are the type of future contracts unique to the crypto market. The mechanics are similar to futures, except that perpetual futures do not have an expiry date. Trader can hold the contract for as long as they wish to until they close the position of their own accord or forced into liquidation due to margin issues. What are options? Crypto options are a type of derivative contract agreement that gives the holder the right, that is the option, but not the obligation to buy or sell a specific underlying asset, such as a cryptocurrency at a set price, referred to as the strike price, up until a set future date, also known as the expiry date. Call options and put options are two main types of options. Both can be entered into as a long position, that is the buying position, or a short position, that is the selling position. They are also leveraged instruments because the amount paid to hold the option is small relative to the total contract value. Similar to futures, options can also be cash settled. The amount paid by the option buyer to the seller is known as the premium. long call option, long put. These are the like basic uh, definitions of long call option, long put option, short call option, and short put option. So long call option, a holder has the right to buy the asset at the strike price at any time up until the expiry date. To purchase the option, a price referred to as the premium has to be paid to the seller of the option, also known as the option writer. Then comes long put option. A holder has the right to sell the asset at the strike price at any time up until the expiry date. To purchase the option, a price referred to as the premium has to be paid to the seller of the option, also known as the option relator. Short call option. Selling a call option and receiving a premium from the buyer, the option holder is obligated to sell the asset to the option holder at the strike price at any time the option holder chooses to exercise their right to buy up until the expiry date. Short put option. Selling a put option and receiving a premium from the buyer, the option holder. Obligated to buy the asset from the option holder at the strike price at any time the option holder chooses to exercise their right to sell up until the expiry date. So, at any time before the expiry date, the crypto option holder can decide whether or not to exercise their option. A major factor affecting this decision is usually where the market price is in relation to the strike price. This determines whether a profit or loss is made from exercising the option. Options are referred to as in the money, out of the money, or at the money, depending on where the current market price is compared to the strike price. The option holder can also decide not to exercise at all, even when the expiry date occurs, in which case the option expires and the holder just loses the premium paid. Options can also be categorized as American or European style by the respective definitions. American options can be exercised at any time before the expiration date of the option, while European options can be exercised only on the expiration date. Long call option. As previously explained, long call option, it profits when the market price is above the strike price plus the premium because theoretically, like Jane could exercise the option and buy the asset at the lower. Jane is an example here. She's an option trader. So Jane could exercise the option and buy the asset at the lower strike price than. Wait a sec. Okay, this chart is related to the example that we are showing. So Jane could exercise the option and buy the asset at the lower strike price, then sell the asset at the higher market price. If the market price is below the strike, then Jake would not exercise the option, thus losing the premium paid. Profits are limited to the premium received from selling the options. Losses occur when the market price is above the strike plus the premium. Long put option, it profits when the market price is below the strike price because theoretically Jane could buy the asset at the lower market price and exercise the option and sell the asset at the higher strike price. If the market price is above the strike price, then Jane would not exercise the option and thus loses the premium paid. Short put options. Profits are limited to the premium received from selling the option. Losses occur when the market price is below the strike price. There is a special option called a knockout with a predetermined flooring and ceiling level, also known as the barrier price level. The option contracts automatically terminate, like get knocked out and cease to exist if the underlying assets price touches any predetermined levels. This is not to be confused with the strike price, the price at which the option holder buys or sells the asset if they exercise their right to do so. The knockout feature potentially limits profits and losses for both for both of the option holders and option sellers. So futures versus options. Crypto future contracts give traders the obligation to buy or sell an underlying asset, while crypto options provide traders with the right but not the obligation to buy or sell an underlying asset. In futures, risk is high as open positions can be liquidated. In options, risk is limited to premium amount only. And in futures, it is like cost effective as traders do not have to pay upfront costs other than transaction fee and funding rate. And in options, contracts require premium payment. In future contracts, they are resistant to time decay. Like they don't have any expiry date. While options, they have an expiry date. They become less valuable as the expiry date comes closer. So market analysis, current state of crypto futures and options. The crypto futures and option market has seen significant growth in recent years, with trading volumes increasing steadily. In 2020, the total volume of Bitcoin futures traded on the CME, Chicago Mercantile Exchange, reached an all-time high of over 1 trillion. And right now, in like 2003, I would say it reaches almost $2 trillion within a week or so. So, however, the market is still relatively small compared to traditional financial markets, and regulatory uh, uncertainty remains a challenge for investors. Additionally, the high volatility of cryptocurrencies can make these instruments risky for inexperienced traders. Factors affecting crypto futures and option prices. The prices of crypto futures and options are affected by a variety of factors, including the overall market sentiment towards the cryptocurrencies, the supply and the demand of the underlying asset, and geopolitical events that may impact the industry. Additionally, the prices of these instruments can be influenced by technical analysis indicators such as moving averages, trend lines, as well as fundamental analysis. Factors like news and announcements from major players in the industry, plus future like the prices of crypto, they are very volatile on days when some data is released in USA, like some laws are discussed. The prices are highly volatile. Like on 12th April, tomorrow, when the Ethereum upgrade will be there, the prices will be volatile tomorrow as well. Risk management strategies for crypto futures and options trading. Due to the high volatility of the cryptocurrencies, risk management is crucial for traders involved in the futures and options market. One common strategy is to use stop loss orders to limit potential losses in case the market moves against the trader's positions. Another approach is to diversify one's portfolio by investing in multiple cryptocurrencies or other asset classes. Additionally, it's important to stay up to date on market news and trends and to have solid understanding of technical and fundamental analysis strategies. Future outlook for crypto futures and option market. As the crypto industry continues to mature, it's likely that the futures and options market will become more established and regulated. This could lead to increased participation from institutional investors and greater liquidity in the market. Additionally, advancements in technology such as blockchain based contracts and decentralized exchanges may offer new opportunities for crypto derivatives trading in the future. Um, this was a very quick presentation. So I've reached the conclusion. Crypto futures and options are complex financial instruments that require careful consideration, and risk management. However, for those willing to take on the risks, these derivatives can offer exciting opportunities to profit from the growth of the crypto industry. As the market continues to evolve and mature, it's important for traders to stay informed and adapt their strategies accordingly to stay ahead of the curve. So you guys can follow me on Twitter. It's at the rate the Money Kong. I also run a small channel for crypto traders where I share like my views, my opinions on what type of trades I'm taking. I mostly do futures trading, and like I have around 500 crypto traders like who trade along with me. So those who are interested, I share my views. You can join my channel, and plus you can send your questions to me whenever you like. And so yes, Prajakta.
Yes. Thank, thank you, Mr. Aram. That was a great presentation for taking out time and sharing your views on today's topic to all our audience. Also, thanking all the wonderful audience who have shown interest in learning and making informed decision before entering the crypto market. I would now request Mr. Aram to address the question raised by our audience. Here is the how risky is crypto future?
Crypto futures, how risky? Okay.
Yeah.
Crypto futures, crypto is actually very volatile and
Yes.
can become illiquid at any time and is for investors with high risk intolerance, like tolerance. Investors in crypto could lose the entire value of their investment. So to be honest, it's really very risky. If somebody, like as I said in the presentation earlier, for those who are inexperienced, they should first start learning uh, how the market works and what things happen and what are other people's doing. So we should keep looking at other traders as well and learn from others, because we could lose the entire money that we have inside our wallet.
Right. One more question we have received. What is the difference between spot and future market?
Okay, so crypto futures trading versus crypto spot trading. There are like three main things. Number one is leverage. Uh, People like traders are drawn to the futures market because of leverage. Leverage makes futures trading extremely capital efficient. For instance, to purchase one BTC in the spot market, right now one will need almost $29,000 based on the prevailing market rate. And with a futures contract, we can open a BTC futures position at a fraction of that cost. So this is only possible with the use of leverage. That's why like people, they prefer crypto futures instead of spot, because in spot we'll have to spend $29,000 to get one BTC. So the higher the leverage, the less we need to spend on a position. In contrast, um, we have the second thing is flexibility to long or short. When you purchase Bitcoin in the spot markets, you make a profit only if the price goes up. However, in the bear market, you can't make
Okay.
money. Sorry. Futures contracts allow you to profit from short-term price movements regardless of direction. Even when the price of Bitcoin falls, you can participate in the downward movement and trade along with the momentum. So with the future contracts, traders can develop sophisticated trading strategies such as short selling, arbitrage, base trading, and many more. Additionally, future contracts are also used to hedge against downside risk and protect a portfolio from extreme price volatility. Miners and long-term holders often use future contracts to protect their portfolios from unexpected risks. Um, and third is liquidity. The futures market, they offer deep liquidity with trillions in monthly volume. For example, the Bitcoin future market sees an average monthly like turnover more than $2 trillion, far greater than Bitcoin spot market's trading volumes. Its robust liquidity supports the process of price discovery and allows traders to transact in the market swiftly and efficiently. A liquid market is generally like it is associated with less risk because there is always someone willing to take the other side of a given position. So this way, the traders will incur less slippage. So, and the fourth one is futures versus the spot prices. Price of this, they both are the same. Like only thing that we have, like in futures, we get liquidated, and in spot, we can hold it forever. There's no time limit.
Okay.
Even if the coin goes to zero, still we'll have it. In futures, we have a specific liquidation price.
Okay, thank you, Mr. Aram. That was very helpful.
Thank you so much, Prajakta, for
Yeah.
inviting me here, and thank you everybody. If you'd like to ask me any question, you can reach out to me on Twitter. I have I'll share my Twitter handle in the chat box.
Thank you for attending, and we will now be meeting all of you in the next webinar.
Thank you.